My name is Rick Blanke, Managing Partner of Blanke Schein Wealth Management, and welcome to the next installment of our Financial Foundation series. Before I get into the topic of what we're going to discuss today, I did want to address, for those of you that have seen previous Financial Foundation videos, it might look a little bit different with a mic in the shot today. We are setting up and we're doing some practice runs of our podcast that will be dropping within the next couple weeks, maybe a couple months. So be on the lookout for that. But in this episode of Financial Foundation, we're going to discuss short squeezes. We're going to talk about what they are and kind of the dynamics behind them. And have we seen any examples of a short squeeze in the recent past? Let's dive in. So let's discuss short squeezes. In order to understand what a short squeeze is, we have to understand what shorting a stock means. When you short a stock is when you as an investor borrow shares from a third party that you then take those shares and sell them on the open market. As the investor, you're assuming that the stock that you're selling, the shares of stock that you are selling, the stock price is going to decrease. Because to close out the position, you have to buy those shares back and then return the shares to the entity that you borrowed the shares from. So for example, if you buy shares of Apple, for instance, and then sell those shares at $100 on the open market, you're assuming, let's say the share price drops down to 90, you're going to buy those shares back at $90 and return those shares to the third party that you borrowed them from. But you're going to profit that $10 per share. The downside is if you borrow the shares and then sell them at 100 and the stock price goes up to 110, you still have to buy those shares back to return them to the person or entity that you borrowed them from. But what's going to happen is you're going to have to pay that differential. That is what shorting stock means. So now that we know what shorting a stock means, what is a short squeeze? Well, it's the same thing. You have people who are shorting a stock, but then you have another group of people that are adding tremendous buying pressure to that same stock, which is driving the price up. Now, what happens in a short squeeze is as the price is driven higher, people who have short interest or people who have shorted the stock start to get nervous and start having to or are forced to close out their short interest position because they don't want to continue to lose money as the stock price rises. So what's happening is they are buying the shares to close out their position so that they can return them to who they borrowed them from. But as they're closing out their short interest position by buying the shares back, that's putting additional buying pressure, which is making the stock price rise even more so. That's how you see these outsized, 100, 200, 300, 400% gains that are just astronomical because it's all this buying pressure from people, in addition to people wanting to buy the stock, but also from people closing out their short interest position. So there's a couple recent examples of short squeezes that have happened just in the last couple years. One of which was Tesla. Tesla in early 2020 was one of the most, or if not the most, heavily shorted stock on U.S. exchanges, with over 18% of the shares outstanding being shorted. Through the buying pressure and through the closing out of the short interest positions, which remember is buying the shares back, through this immense buying pressure, the shares rose over 400% over the next couple months, which led right into March of 2020 when Tesla and the market as a whole, for the most part, pulled back drastically. Another example of a short squeeze is are the meme stock craze, right? So there was a company that was a brick and mortar retail store that sold video games and video game consoles. And the problem with that is that people don't, for the most part, people don't go to the physical stores to buy the games anymore. They either stream them or they buy them virtually online through the consoles themselves. So what had happened was there was extreme short interest in this company. But some people may have heard the term Wall Street bets. That's a Reddit, Reddit site where everybody was going, all the young investors were going to get financial advice, which can be dangerous. So you got to do a lot more research than that. But what was happening was these people were then buying up this company, which was showing hundreds and hundreds of percentage returns over the coming days and weeks. But again, there's extreme volatility associated with this type of trading. So you saw extreme highs and then extreme lows. So do your own due diligence, research the companies, don't get caught up in the next craze. But it is important to be able to look at and point out what could possibly be a short squeeze to protect yourself. So we've taken a high level look at what a short squeeze is. We've looked and helped identify what could be a short squeeze and what may not be. It's important to remember the risks associated with short squeezes, and it's always important to do your own due diligence. We'd love to get into more detail about short squeezes. Let us know in the comments or via email or phone call if you'd like us to dive deeper. But thank you so much for watching, and we look forward to seeing you on the next one. Thanks.